Hi everyone, welcome to today's accounting design project. Today is the last event of the season, and we have Ted Christensen along with his co-author Jack Wong and Melissa Louise Weston to present a paper about non-GAAP earnings. Ted, the floor is yours for 60 minutes.
Thank you. I really appreciate everybody taking the time to join us today, and we look forward to any feedback that you may have. So first of all three of my co-authors are here. So Melissa, I thought I saw earlier, Melissa's here somewhere. Jack is here, Jack Wong, and Colin Rabe. And so if I make any mistakes, they can jump in and correct me. So this is an interesting paper. It has come about in a very interesting way. We started off just I don't know, I guess it's been almost 2 years now, but we were kind of looking at market reactions to GAAP earnings and non-GAAP earnings, and we were kind of doing some firm-specific regressions, and we found that in some instances we were finding a stronger reaction to GAAP earnings than to non-GAAP earnings, which really got us thinking about what was going on. Obviously, markets can react differently to different firms and their disclosures, but it kind of led us into a very interesting process of discovery. So I've been working in this area for almost 25 years, and a lot of the early research in this area I was involved with. And so it really was hard for me to kind of sometimes rethink some of my own priors about what I thought I knew about non-GAAP earnings. And so that's kind of the title here. Do we really know what we think we know about investors' reliance on GAAP and non-GAAP earnings? So if you don't mind, I'm going to take the first few minutes and kind of lay some groundwork. I've presented this paper several times, and if we don't get a foundation, people tend to get confused. So I'm going to try to give you the most straightforward possible explanation as I can. All right, so just to kind of kick things off, I will tell you that this is not meant to be a criticism of prior research, because a lot of it's my own research. And so if I'm criticizing anybody, I guess it'd be myself. But I do want to say that this has really caused me to rethink, the way I think about things. So I've talked to doctoral students and junior faculty, lots of different places. In fact, the next two slides I'm going to show you, they come almost directly from what I presented to some doctoral students last year. So when I would talk to them about non-GAAP reporting, I would say, like the big question that we started off with was, do investors pay attention to non-GAAP earnings metrics? And I talked about how, there was a lot of concern among regulators, was a lot of articles in the financial press, people sort of criticizing this practice. And so basically this idea of GAAP versus non-GAAP performance metrics, what do people actually pay attention to? And so I talked about the early horse race literature, which I was part of, which basically concluded that investors pay more attention to non-GAAP earnings than to GAAP earnings. And so citing some of that early research, Bradshaw and Sloan were the very first, and their conclusion was that non-GAAP earnings had sort of replaced GAAP earnings as the primary determinant of stock prices. And then one of my first papers came out and said basically that both analysts and investors react more to non-GAAP earnings than to GAAP earnings. And there have been other follow-up papers. Now, this paper right here, Bradshaw et al., I'm part of the et al., and it says we provide strong evidence of a preference for non-GAAP earnings. And I actually, I changed the word strong and said basically definitive. Okay, we knew this. This is something that we absolutely knew based on that study. And so that's why, with such strong priors, this paper has been a real discovery process for me. Okay, so typically when you think about it, when regulators or investors or academics are talking about a preference for non-GAAP performance metrics relative to GAAP earnings, what do you think they mean? So I think most of the time they think that it's a better measure of performance, and it's because it has a stronger association with earnings announcement stock returns. Okay, well, so think about that interpretation just a little bit, and Melissa was kind of helping me out with thinking about how to better present these ideas to people. But if you think about it, you take the total GAAP earnings, and usually managers will exclude certain components of the GAAP earnings number to arrive at their non-GAAP earnings number. And so most of the time they're excluding expenses, and so therefore the GAAP earnings number is here, the non-GAAP earnings number is going to be higher, right? And so the question is, when you think about this idea of how markets react, what are they reacting to? So if you have do they do they react equally to a 1-unit surprise in non-GAAP earnings when the GAAP earnings represents 10% or versus 90% of the non-GAAP earnings figure? Okay, so if you think about the 90%, then the exclusions are actually a fairly small proportion versus if GAAP earnings is only a small proportion of non-GAAP earnings, it would be much bigger, right? And so I guess the basic idea is that when GAAP earnings explain 90% of non-GAAP earnings, investors are likely to place more weight on the non-GAAP surprise than when GAAP earnings only explain 10%. Okay, so when we say investors prefer non-GAAP earnings, what do we really mean by that? Okay, some of you might remember The Princess Bride. I do not think that means what you think it means, right? And sometimes that's how I felt as this 1.5-year process with my co-authors trying to help me wrap my head around maybe thinking about things differently than the way I have for 25 years. Okay, so the basic idea is that the strength of the market response may reflect the quality and credibility of the underlying components rather than a general preference for just non-GAAP earnings versus GAAP earnings in general. And so interpreting stronger reactions as blanket preference may be oversimplifying or maybe overgeneralizing what's really happening. Okay, so how does our paper help with this kind of situation? So first of all, prior research typically focuses just on comparing GAAP earnings and non-GAAP earnings as a whole. And think about it this way, the value of non-GAAP earnings is related to the level of GAAP earnings, right? But there are different components. And so when you think about it, there's the market reaction to the GAAP earnings surprise that's included in non-GAAP earnings. There's the market's reaction to the GAAP earnings surprise that it's excluded in calculating non-GAAP earnings. And there's another effect that we introduce in this paper, which is like the relative mix of the exclusions and non-GAAP earnings. So we'll explain those effects in just a second here. Okay, so because GAAP and non-GAAP earnings are very highly correlated, they overlap a lot. When you use single variable models to try to compare the two, you come up with basically biased coefficients that are biased in favor of non-GAAP earnings. Other ways that it's done, typically you'll have two multivariate models with two explanatory variables. Here's the problem, and I'll talk about this more, but basically GAAP earnings is composed of non-GAAP earnings and exclusions. And so those three variables are a linear combination of one another. And so mathematically, you can only put two of those variables in the model at the same time. And so when you do that, any combination of two is going to yield mathematically equivalent results. And where we've struggled in the past is that sometimes we interpret those coefficients inappropriately. Okay, so overall market reactions to non-GAAP earnings cannot be interpreted as a clear preference for one relative to the other, and we'll talk about why in a couple of minutes here. They are highly correlated and they are released simultaneously. So when we measure a market reaction to an earnings announcement that includes both the GAAP earnings number and the non-GAAP earnings number, you can't say that reaction is to one or the other. It's really a reaction to both signals that are being relayed simultaneously. All right, well, looking just quickly at prior research, and I'm a big part of this, so I'm part of the et al. On two of these papers. But the conclusions, Bradshaw and Sloan's original conclusion was that the market response to street earnings number has displaced the GAAP earnings number as the primary determinant of stock returns. My first paper in this area, we said that pro forma earnings are more informative and more permanent than GAAP operating earnings. And then later, I'm part of the et al. Of this one too, the Bradshaw et al. We said we provide strong evidence of a preference for non-GAAP earnings. And so we went back and looked at the total citations for those papers. And this is the main conclusion, right? What's listed here is the quote. Usually the majority of studies that cite that conclusion. And very rarely is that conclusion ever challenged in any way. In fact, the three here, two of them are the same papers we see down here. So no one has really thought about how we interpret, make these interpretations of these conclusions. And so basic idea is, like nobody's ever challenged this conclusion here because it's a fairly recent paper. But basically, it's more complicated and it's more nuanced than we had thought in the past. All right, so basic research questions, kind of the broad picture. Do we really know what we think we know about investors' reliance on GAAP and non-GAAP earnings? That's what our title is. Basically, how can we reconcile our idea with these single variable models, which are sort of biased in favor of non-GAAP earnings? Given these three components that I've sort of mentioned here, is there a better way to interpret the coefficients that's really more correct, more exact? And then, given this fresh insight, how do investors and analysts react to these different specific reactions? All right, so just some definitions, fairly straightforward. As I mentioned, GAAP earnings equals non-GAAP earnings minus exclusions, or you could rearrange that and say non-GAAP earnings equals GAAP earnings plus exclusions, or you could say exclusions equal non-GAAP earnings minus GAAP earnings, right? So it's an identity. And so those three components are linear combinations of one another. So obviously, if you take this to the forecast error level, the same would hold true. All right, so first of all, let's talk about these single, well, actually, I'll talk about both types on the same slide here. But basically, if you look at prior research, most of them have performed both the single variable explanations as well as the multivariate regressions. Okay, so single variable models, Bradshaw and Sloan, if you look at it here, clearly the coefficient on non-GAAP earnings is higher than the coefficient on GAAP earnings. Same thing in our paper, same thing in Logi and Marquardt, and same thing in the Bradshaw paper. So the coefficient on the non-GAAP earnings is higher than the coefficient on non-GAAP on GAAP earnings when you just run these single variable models. Most of them also have a two variable model, and sure enough, when you put them both in the same model, you find that the coefficient on non-GAAP earnings is higher than the coefficient on GAAP earnings. And so hence the conclusion from prior research that investors have a preference for non-GAAP earnings. Steve, you got a question there?
Yeah, these coefficients are really PE ratios in returns rather than levels, okay? So it's very helpful. You can actually just do it deterministically, is to convert these into PE ratios, okay? The equivalent PE. And that just helps, I think, the view of it, how the earnings are priced, okay? And I think that's a nice way to present it, to get people are familiar with PE ratios, not PE ratios in returns.
Yeah, very straightforward way of thinking about it. Exactly. Okay. Well, so first of all, let's talk about the single variable models. Okay. And so basically, if you look back here, if you just regress abnormal returns on the non-GAAP earnings surprise and on the GAAP earnings surprise, what do we find? Well, first of all, I want to just mention, remember the earnings announcement comes out at a point in time. Both numbers, okay, so by definition, the SEC in Regulation G requires firms, if they're going to disclose a non-GAAP earnings number, they have to reconcile it back to the corresponding GAAP earnings number, right? They have to. And so anytime you see an earnings announcement that includes non-GAAP earnings, it has to, by definition, include also GAAP earnings. Okay, so if think about the market reaction around that very tight window, it's a reaction to all of the information that was disclosed, right? Both signals are coming out at the same time. Okay, so if you think about it in that way, then in this model here where you have just one explanatory variable, like the non-GAAP earnings surprise, notice the coefficient 1.858. Well, so there's an idea of this omitted variable bias because you also had the GAAP earnings simultaneously disclosed, right? So if you come over here, this is the estimated coefficient that we get from that regression. And so if you think about the bias by omitting GAAP earnings, then it would actually lower the coefficient a little bit. And what would be the bias if you omit the exclusions? It would also lower it just a little bit. Okay, so in both cases, it does decrease it a little bit, not much, right? There's not a lot of bias in this first regression. However, if you look at the second regression, when you just include the non-GAAP earnings surprise, notice how low that coefficient is relative to what we saw in the first regression. It's very low. Well, but look how much bias there is. So, for example, if you leave out the exclusions forecast error, notice that the coefficient will be much, much higher absent that bias. And also look that it's exactly the same. So if you include non-GAAP earnings in the model and exclude the exclusions, you would come up with a coefficient of 1.84, and you get the exact same number, the exact same coefficient, if you had included GAAP earnings and you had excluded the exclusions forecast error. Okay, so again, that just gives you an idea of how these single variable models are biased in favor of non-GAAP earnings. Right, so a lot of prior studies have focused on two variable models. Okay, so the first one up here, Bradshaw and Sloan, they include the non-GAAP earnings surprise and the GAAP earnings surprise. Also, our first paper. More recent papers, the Bradshaw et al. 2018 and more recently McVeigh et al. Include the non-GAAP forecast error and the exclusions forecast error. Our paper actually focuses on the third way. You can only have three combinations of two variables, explanatory variables. And so this is what we actually use in our paper. Okay, again, the idea is, since those three variables are linear combinations of one another, that the coefficients that you get in any of these three specifications will be equivalent. Young?
On text, I think Gil Zaka has a question. Gil, do you
Sorry.
want to ask a question?
I wrote it in the text. I just I don't know if you guys can hear me well, but if the forecast is a forecast of non-GAAP earnings, then what we have is a forecast error for non-GAAP. Then we do not have a forecast error of GAAP. The market reacts to the word reaction is to a surprise. So for us to have a surprise, that means if we have these two types of earnings, then we have two different types of forecasts in the investor's mind. If what you have here is the analyst forecasting the non-GAAP earnings, so let's assume the analysts in the markets have exactly the same expectations, then you have a unbiased and a good measure of forecast errors for the non-GAAP. But your forecast error for the GAAP is measured with a lot of error,
Right?
Because you didn't. This is not the market forecast of a GAAP number. It's the market forecast of the non-GAAP number, and vice versa. If the forecast was for a GAAP number, then you have a correct forecast error for GAAP, but you have a biased or a noisy, at the very least, measure of the non-GAAP forecast error. So it really depends on what the analysts are forecasting.
Exactly. So excellent point. If you go back to these early studies, Bradshaw, Sloan, and Bhattacharya et al., the big issue there was we only had one forecast. So back in those early days, IBIS just said, here's our street earnings forecast. And you didn't know if analysts for that particular company were forecasting the GAAP number or the non-GAAP earnings number. And so in our original paper, Bhattacharya et al., it was in the JAE conference. And so Mark Bradshaw was our discussant, and that was his big thing, measurement error. Because really they're forecasting one thing, and you can't use that same forecast to compare to both actual numbers, right? So that was the big innovation of this Bradshaw 2018, because later IBIS started capturing forecasts from analysts of GAAP earnings and non-GAAP earnings. So then we could then separate out. We had an expectation for GAAP earnings and an expectation for non-GAAP earnings, right? So the forecast errors were being calculated without that bias. So that errors and variables problem that Mark Bradshaw had complained about. So that's why we said we had basically definitive evidence in the Bradshaw et al. 2018 paper, because we had an accurate GAAP earnings forecast and a non-GAAP earnings forecast. I hope that answered your question. But you're exactly right. That's exactly what we thought. Hey, by the way, Colin, maybe you and Jack can be monitoring the chat. I can't simultaneously monitor the chat, but if you can kind of be watching and maybe responding to some of those questions as we go.
Pat, may I ask a question?
Yes.
So 2 years ago, Patty Chow actually presented on this platform about a rating system for the quality of the non-GAAP exclusion items, the item by item. So I think I resonate with your earlier points about, instead of focusing on non-GAAP versus GAAP, focusing on underlying quality and credibility of the line items. And her paper kind of speak on mostly just the serial correlation, how persistent individual line items. So previously in your motivation, you used Melissa's example that focusing on the level, but when you run regressions, what it matters is actually individual line items, autocorrelation, right? And whatever is more persistent will actually have a higher P multiple ratio. And is that something kind of like concluded? What you find here is actually just the persistence of the individual line items.
So that's a very good point. So each firm, when they disclose non-GAAP earnings, they have to reconcile it back to GAAP earnings. So if investors are paying attention to that firm, they can actually see the reconciliation and understand better what managers are excluding. And so I agree with you that when you get down to the granularity of knowing exactly what's been excluded, then you have a better idea for the quality of that measure. And so obviously, investors being sophisticated, if they have that kind of detail, they can actually react to what they view are correct exclusions versus maybe more questionable exclusions. Now, we can't capture that level of granularity in our data. So Patty, when she did that paper, she had some data from Audit Analytics. And so it was just for a snapshot. I can't remember the exact years. I want to say like 2016 to 2018. It was a pretty small window. But they had the detail for those. And so that's why that study is very unique in that they were able to get into the details of what investors might be reacting to. But we actually don't have that level of detail here.
But related to, because your paper kind of read it more like a methodology paper, right? So like, I think, can you run a simulation that's whatever is more persistent is going to have a higher coefficient, regardless if it's GAAP, non-GAAP, or exclusion? It's like going beyond the labeling. I think what's underlying driving those coefficients is just the serial correlation of that particular line item relative to abnormal return, right?
Right.
And
exactly.
we can use that in the statistics literature that persistence and then, yeah.
And I will say that over time, things have changed a little bit. So back in the early days of non-GAAP reporting, companies were primarily excluding one-time, gains, losses, those kind of things, just sort of special items. But as the accounting standards have changed over time, we've seen kind of a shift in what people are excluding. And so, FAS 123R, firms started excluding stock comp when they were required to expense it. Similarly, FAS 141R, firms started excluding amortization of intangibles. And so it became more common for firms to be excluding the same thing over time. So initially, while the SEC had cracked down and said you can't exclude recurring items, once firms started excluding these things, they basically said, well, you can if you're going to be consistent. So if you're going to always exclude stock comp, do it every single quarter, not just randomly. But anyway, you're right. The correlation, so this idea of persistence, of course, maybe has changed over time. But there is a difference in quality of different types of exclusions, and we can learn a lot about that from Patty's paper. Henry, you had your hand up also.
Yeah, hi. Mine was just a comment on Gil's comment, and I just wanted to point out a paper I'm aware of that was published in Accounting Review, calling into question the quality of these GAAP forecasts. So they looked around the TCJA, which was an event where you could kind of predict a special item in GAAP earnings related to income tax. And they concluded that analysts don't try very hard to forecast this component that they know will be a part of GAAP earnings. They just don't exert much effort in forecasting it. So, and then they do some bigger sample tests too, but I think the point there was calling into question whether the GAAP earnings forecast, called GPS and IBIS, whether that is actually investors' expectation of GAAP earnings or not. And so I just wanted to bring up that possibility.
Yeah, excellent. Great comment. Okay. Well, before we go in too much into these two variable models, again, they give equivalent results, but you have to be careful in how you interpret coefficients. So Colin, who's on here, Colin came up with a great example to help, because as I would present this paper, or we present it at different places, people would get confused. And so I'm hoping this example can help to kind of clarify a little bit what we're talking about. So just take a really simple example. A company has GAAP revenues. These are actuals, 800, expenses 700. So the GAAP income is 100. The company decides to exclude expenses of 8 and some revenues, maybe like some one-time, maybe a one-time gain or something like that. So net exclusions are 5. So if you take the GAAP income of 100 plus the exclusions, then the non-GAAP income would be 105. So then you have forecasts of each of these components, and so a forecast error for each one. All right, so I'm going to give you 3 scenarios to help illustrate what we're talking about with the 3 effects that, oops, what happened here? Sorry. All right, so let's assume over here that a company, so you have, let's assume that hypothetically the company has $1 extra of GAAP earnings that had not been anticipated. So we've got a forecast error of $1 in GAAP earnings. Now, the company can choose what to do with that. They can exclude it or not in calculating non-GAAP earnings, okay? So if they decide not to exclude it, what are they signaling? Hey, we had some extra income, we hadn't anticipated it, we're not excluding it, so we're signaling that's kind of persistent income. We think it's going to be around, so it's included in the calculation of non-GAAP earnings, right? So there's no change in non-GAAP earnings. And so we call this the included income effect. So managers are explicitly signaling we got some extra income and we think that's legitimate. It's going to be persistent, as Young was just saying. And so they're signaling that it's a high quality exclusion. Let me go through these 3, Henry, and I'll come back to your question. So then the next situation, let's assume the same thing. We've got $1 of unexpected GAAP earnings, but this time we choose to exclude it when we calculate non-GAAP earnings. So now what are we signaling? Well, it's a one-time gain. We don't think it's going to be around in the future, right? So we're sort of signaling that it's a transitory event. And so then, hold on one second. Sorry, dog was barking. So again, this time, same $1 surprise, but we're going to exclude it. We're basically signaling that it's more of a transitory item. And so we call this one the excluded income effect. Okay, finally, you can have a situation where no change in GAAP earnings, but we have a change in the composition. So we're going to choose to exclude $1 extra of GAAP income, but that increases non-GAAP earnings by $1. So we've taken the composition of GAAP earnings and we've shifted it around between exclusions and non-GAAP earnings. So we call this, sorry, I just skipped ahead, the composition effect. Okay, so these are the 3 effects. $1 surprise in earnings, and we don't exclude it. Okay, that's the included income effect. Let's back up here. $1 surprise that we do exclude, we call that the excluded income effect. And then no change in the GAAP earnings number, no surprise there, but we change the relative composition of that GAAP earnings between exclusions and non-GAAP earnings. That's a composition effect. Okay, Henry, you had a question. Sorry, I just want to get through that example before we went to you.
Oh, I'm sorry. I just wanted to ask you, maybe it's not even relevant anymore at this point, but what is even the purpose of excluding stock compensation or amortization of intangibles? I mean, these are persistent items.
Right.
And in that case, we're almost positive management's not trying to separate persistent from not persistent items in that case. So how should we think about those exclusions?
Well, I'm going to give you 2 explanations. One is a historical. Okay, so historically, companies were not excluding stock comp. FASB says now you need to start excluding it, and they wanted to say, hey, in the past we never have done this, so we're going to exclude it now, so you can compare this, non-GAAP earnings this period to our earnings in the past periods. That's one explanation, at least historically, why they started to exclude it. The probably more reasonable explanation they're giving now is they're saying that these are non-cash items. Now, Henry, I'm aware of your paper, so I'm going to give a shout out to Henry's paper. So what firms have been arguing with respect to stock comp and amortization is, yes, they're recurring expenses, we know that, but they're non-cash items. And we're trying to give people a signal of what we feel like our recurring cash, like operating cash flows are going to be. And so if that's their rationale, not that it's a transitory earnings item, they're saying it's a non-cash item. So that's their explanation. I love Henry's paper. So if you get a chance to read it, basically what he finds is that a lot of firms So for example, they exclude stock comp. They say it's non-cash, but really what they're doing is then they're going to go out and buy back treasury shares so that they can have shares on hand to satisfy when people exercise their stock options. And so it wasn't really a non-cash item. It wasn't exactly linked to it, but those two transactions took place at the same time. And so it's not really non-cash. So great paper. Take a chance to read it if you get a chance. Another comment, Henry?
Well, I just wanted to say, so I think I'm just wondering, are we assuming that the objective is to maximize the composition effect? Like, are we assuming that manager's objective is to separate items with a high ERC from items with a low ERC? When they're clearly not doing that. If it seems clear that managers are not trying to maximize the difference in ERC between non-GAAP earnings and exclusions, right?
Yeah, I remember when I was presenting this paper at Illinois a couple of months ago. I was having a hard time articulating really well the composition effect. Colin, do you have an explanation on that? You might be able to help us out here.
I'm trying to think if we can say something definitive in regards to that. We're kind of being a bit more agnostic, I think, and saying the managers are just saying, hey, this part of it is non-GAAP, this part is exclusions. And then we're going back and seeing how the market reacts. Now, whether the managers are purposefully trying to get the non-GAAP ERC to be bigger than the exclusions is maybe something for debate. But ostensibly, that's what they would expect to be happening if they are truly identifying core recurring items as opposed to things where they're saying nobody should pay attention to this because it's a transitory item.
I agree. And this isn't a comment on whether the conclusions of this paper are appropriate. I think they are. It's just, it seems clear that not all managers have the objective of identifying transitory items. Like that's not the only objective of non-GAAP reporting, it seems.
Yeah, and I think that's what we're hoping to be able to suss out a little bit then is if that's not fully the objective, then the ERCs maybe should be closer together between the non-GAAP and the exclusion items. And so that's going to vary firm by firm depending on the credibility of the management in terms of what they choose to exclude and so on.
Okay, well, thank you. So let me just summarize here what we are trying to articulate with these three examples here. So in the past, researchers, including me, okay, so it's not a criticism, but we've run these regressions and we've interpreted the coefficients very broadly to say this is the market reaction to GAAP earnings, this is the market reaction to non-GAAP earnings. When in fact, there's three different effects here, and they're a little more nuanced than what we had previously thought. So, how are investors reacting to these signals from managers? Okay. If managers only disclose GAAP earnings, which happens quite frequently, then there's no signal at all. If they disclose both GAAP and non-GAAP at the same time, then there's some implicit information in what they include versus what they exclude, right? So that extra dollar of income I was talking about in this example, it could be included, which is a good signal that this is probably a part of their core earnings. They could choose to exclude it, in which case they're signaling this is probably a transitory item. Or maybe there isn't a surprise in GAAP earnings, but we see sort of a change in the allocation or the composition of non-GAAP earnings versus exclusions. And so those are three very specific effects, but that we've been interpreting very, very broadly. Okay, so again, we're just maybe, in fact, Colin sent an email to me earlier this morning saying maybe our paper is more about semantics and how we talk about things than it really is about just the overall conclusion of the regressions. So I want to show you these two variable models, and let me just point out. So model 4 that you see right here from table 4. This is where we include the non-GAAP earnings surprise and the GAAP earnings surprise together in the model. And that's Bradshaw and Sloan and Bhattacharya et al. Again, I'm part of the et al. More recent papers, so the Bradshaw et al. 2018 and McVeigh et al. 2024, they include non-GAAP earnings and exclusions in the same model. And then we're actually advocating this model over here where it's GAAP earnings and exclusions, and we'll tell you why in a second. But basically, those three effects. So the included income effect That's what's being captured by non-GAAP earnings in this model, but it's also being captured over here by GAAP earnings in our model. Okay, so when someone is attributing, for example, I'll just say Bradshaw et al., I'm part of that paper, we concluded this is the market reaction to non-GAAP earnings. But notice we get the exact same coefficient on GAAP earnings in this model, right? It depends what you include and what you exclude from the model. Okay, how about the excluded income effect? Well, in the original papers, this was the coefficient on GAAP earnings, but it's the coefficient on excluded items here. And then the composition effect, which no one had ever really talked about before this paper, that's what non-GAAP earnings was capturing in those original models. And that's what the exclusions are capturing over here in our model. Okay, so again, I want to mathematically, the paper does a much better job explaining it than I'm doing, but we can prove that those are exactly the same things. And you just have to be careful how you interpret these different models. There are three models with combinations of two explanatory variables, and they're capturing those exact same effects, but we've been interpreting them much more broadly than the nuanced effect that they're actually capturing. Okay, Colin did a great job of helping to kind of tease this all out. But for example, the included income effect in this model here, this is the more recent Bradshaw et al. 2018. That's the coefficient on non-GAAP earnings. In our model, that's the coefficient on GAAP earnings. The excluded income effect in the original models, that was the coefficient on GAAP earnings. In the more recent Bradshaw paper, it's the coefficient on exclusions. The composition effect, again, in the original papers, that's what we were calling the market reaction to non-GAAP earnings. It's what we find as the coefficient on our exclusions in our model. So again, it's all very nuanced, and until you kind of take some time to think about it, it can be somewhat confusing. Okay, so again, it all depends on what's being included in the model and what you've left out. So you can be controlling for something or holding it constant, and you've excluded something from the model as well. All right, so just basically, here's the model we are choosing to focus on. So we include the GAAP forecast error and the exclusions forecast error because why? We want to focus on, I'm going to come back here, we want to focus on comparing the included income effect, which is always the highest, or traditionally the highest, to the composition effect, because those are the two most strongest reactions. And so we wanted to compare those two. So what we did here in table 5 is basically we started with a very simple model with no fixed effects, no control variables. And we find that those variables are, those effects are very close in magnitude. Oh, by the way, and just to say, you can only include 2 explanatory variables in the model, not 3, but we can calculate what the third effect would be. And so we've calculated the excluded income effect so you can see relatively what the magnitude is. The only change in the second model is we included fixed effects. In the third model, we included control variables without fixed effects. The final model includes both. But basically, we find that those 2 effects are pretty much indistinguishable. The included income effect and the composition effect are not statistically different from one another in the pooled sample. We then, assuming there could be changes over time in these effects, and so we run annual regressions. And again, for most years, we don't find any statistical difference between the included income effect and the composition effect. I think it was only 1 year, if I remember right, but it was different right here, 2009. Okay, so then the next stage so these are market reactions, right? Short window returns around the earnings announcements. We then wanted to see, are analysts learning from managers, right? So how are analysts reacting? So these are analyst forecast revisions in the short window around the earnings announcement. So pretty much the same model, except we changed the dependent variable. And again, we find a very similar result that when you comparing the included income effect and the composition effect, they're just not statistically different from one another. And again, in the past, how have people interpreted these? They're often saying this is the market reaction to GAAP earnings versus non-GAAP earnings. Well, we're saying it's a much more nuanced effect that we're looking at here. We do the same thing in table 8 with the annual regressions. They are pretty much the same most years. We do find more statistical differences in this specification over time. The final thing we do is we go back and do firm-specific regressions, because we assume that some firms have higher quality non-GAAP earnings than others. Okay, Young was talking about, what is it when you get down to the granular level that they're excluding? And so we wanted to assume that there's a possibility that for some firms, investors may react differently than they do for others. And so we do firm-specific regressions against the same model with the same explanatory variables. We have the gap forecast error and the exclusions forecast error. And basically what we find is, so these are the market reaction tests and these are the analyst revision tests. And, on the tails here, we do find sometimes the included income effect is bigger than the composition effect for a relatively small proportion. And we even find at the other extreme that sometimes the included income effect is, the composition effect is greater than the included income effect. But for the vast majority of observations for firms, 81% of the time, we don't find a significant difference between this included income effect and the composition effect. Okay, so that's pretty much the paper. Let me kind of go over just a quick summary and then we can open it up for more discussion. So basically, market reactions to earnings surprises, if we run these individual horse races with univariate explanatory variables in the models, basically we have bias coefficients that are biased in favor of non-GAAP earnings. If we do the two regression models, we can make some comparisons, but we're not really comparing the market reaction independently to GAAP earnings and non-GAAP earnings, right? What's the only way we could do that? Experimentally, we could do it. In the real world, it doesn't exist, because if you announce non-GAAP earnings, you have to simultaneously reconcile the GAAP earnings. We can measure just the market reaction to GAAP earnings alone, because some firms only disclose GAAP earnings. But if you really want to compare, you can't really do it directly in that broad sense. And so again, these two variable regressions, which is what we've been looking at, they provide very nuanced results and nuanced interpretations, whereas prior research has interpreted them much more broadly. Okay, so that's basically what I have. Any other comments or suggestions that you may have? We'd love to hear them. Henry.
I would love to have some example wording that could be used for these regressions. So rather than saying investors have a preference for non-GAAP earnings, it seems like they do, but what should we be saying instead of investors have a preference for non-GAAP earnings?
Colin, you had some ideas you were kind of talking about this morning about how we could say that a little more clearly. Can you articulate that better?
Yeah, I think this has been our biggest struggle in writing this paper and presenting it, is that a lot of it is just about the precision of the wording and trying to figure out how to get that just right. And the thing we're trying to push back against a little bit is this idea that investors prefer non-GAAP to GAAP earnings, because it sort of suggests that they only get to choose one or the other. And of course, if you get one that's closer to core earnings or allows you to forecast better, you would prefer that. But we live in a world where you get both at the same time. And so it's a little bit like saying, would you rather have the GAAP number or the non-GAAP number and the GAAP number? And clearly would you rather have the non-GAAP number or the non-GAAP number and the exclusions together in the GAAP number?
One signal versus two.
Yeah. And so we're still struggling a little bit with exactly how we might want to phrase that. I would say, to the degree that the excluded income effect is greater, or let me flip that around. To the degree that the included income effect is greater than the excluded income effect, it suggests that investors really take these exclusions to heart and really think that this non-GAAP disclosure is providing a lot of additional information. If the investors just saw every dollar of GAAP income identically, then the included and excluded income effects would be identical, and therefore the composition effect would be zero. So when there's a big spread between those two, it suggests that when the managers say, hey, don't pay attention to this excluded stuff, the investors really are not paying attention to it in terms of pricing it into into the equities around the earnings announcement.
Yeah.
So that's a long
That
answer
makes, yeah, that's
with
good.
some precise
Yeah,
phrasing.
that's helpful. And I really enjoyed the calculation and the framing of the composition effect. And what I think I would benefit from, there could be two reasons you've got a high composition effect. The composition effect basically, I think, means that you do a good job of separating earnings into items with high reaction and items with low reaction. I think it's two different scenarios though. You know, normally what we're doing in non-GAAP research is comparing some treatment group to a control group, and how does the treatment group pick exclusions? How does the control group pick exclusions? And sometimes the treatment group will have a higher non-GAAP ERC and the same exclusion ERC. And that results in a high composition effect. Other times they'll have the same non-GAAP ERC and a lower exclusion ERC, which results in a higher composition effect. So I think it would be useful to just talk about those two scenarios and how researchers can kind of phrase the conclusion in different scenarios.
That's a great
Anyway,
insight.
thank you very much.
No, Henry, that's a great insight. Thank you. Because we've been trying to wrap our heads around how do we explain this more clearly. I'll just be honest here. When we first wrote the first draft, these guys had to like pound it into my head. Like we've had these long, hour and a half long meetings, and I was still stuck in my old, paradigm, my way of thinking. And it took them a long time to help me realize that these coefficients are actually telling us something much more nuanced than what I had believed for 20 something years. And then the first time I went to present this paper, I was like super excited, and I was falling back into the same exact way of talking as I was before. Because I was saying, hey, look, half the time they're reacting more to GAAP earnings than to non-GAAP earnings. And so I was still interpreting the old way, but kind of flipping my conclusion here. And it took Colin a long time to help me rein in how I was talking about it. So, but we've still struggled, as you mentioned here, to how do you really articulate what that composition effect is really capturing? And so these are some great ideas. Stephen.
Yeah, you're looking at earnings. They're a bug of mine, which people of ADP have heard before. When you look at earnings, you've got to look at a balance sheet too, because it's a double entry system. Okay. And yes, you can leave out impaired asset impairments in non-GAAP, but that's going to show up in the balance sheet also. Okay. I'm thinking, I'm not sure how you roll this into analyst forecast errors, but it could be that you can get reactions to these, let's say, impairments. The firm at the same time is impairing assets, but really building up assets, okay, which actually cause a market reaction. So in some sense, there's omitted balance sheet information in terms of making inferences from the income statement. So now the one thing interesting, the one thing where you don't get the balance sheet income is stock options, which is a total mess in terms of the balance sheet. So looking at that relative to say impairments or whatever with balance sheet information, I'm not sure it's relevant to your study, but well, yeah, there are controls to look at here, okay, and you have controls, but also that's something further to explore, I think. Okay.
Yeah. Excellent.
We think if investors are totally fixated on earnings and don't look at the balance sheet, that's different from when they employ balance sheets and income statements together.
Another great insight. Thank you. So I think you would enjoy Henry's other paper that we were talking about earlier. You might want to.
Oh yes, I've seen it. Yep.
Okay. Okay, great. Any other comments or suggestions? And by the way, after this discussion, if you get a chance to actually look at the paper, we're really trying to revise the paper now. And so if you have a chance even to read the intro, we would love to get your take on things. Most people who read the intro haven't seen some of the examples we talked about here, and they haven't seen kind of the equivalent model, proofs that we have. And so if you have any thoughts, we would love to, obviously any feedback would be welcome.
Hi, Ted. May I ask a question?
Absolutely.
So this is not my literature. I'm not that as knowledgeable as Henry, but like I think for many years I struggle with the general non-GAAP literature. It is because I feel like non-GAAP earnings is not a well-defined theoretical construct. There are so many different variations from the discussions you have with Henry and the audience, right? Sometimes it's about persistent earnings, sometimes it's they want to capture cash flow. So my question is that the reason you struggle with what implications you can say from this exercise is actually because this term is never really clearly defined. It's driven by many different situations and transactions depending on which firm at which particular year. Is that
And motivation, right? Because the motivation could be to inform about core earnings, or the motivation could be to inform about future cash flows, or the motivation could potentially be to mislead people and overstate your performance. So that's what complicates the whole thing, is like you're saying, there's no definition, and the motivations behind the disclosure could be very different for different companies.
Yeah.
Ted, you gave two reasons why firms add back stock options. Another reason, very cynical reason, could be it's how GAAP does it, okay? Because in GAAP, over the vesting period, we debit the stock option expense that goes to the income statement. And very stupidly, we put the other side of the entry to equity, okay? So once you've closed the stock option down, there's no change in equity, okay? So GAAP actually says there's no change in equity from stock options. And so GAAP says that, let me add it back.
Yeah, that's a good point. I hadn't thought of it that way. I thought of more in terms of Henry's paper, in terms of cash flows and what's really happening with the cash flows.
Yes.
All right, anybody else? We sure appreciate you taking time to come out today, so close to the holidays, and to provide feedback, and look forward to hearing from anybody who has any other thoughts.
Okay, well, thank you very much, Ted and Colin, and who was the third person? I forget, but thank you very much.
Okay, thanks everybody.
Hopefully, we'll all see you in the new year.
That's right. Take care, everyone.
Good to see everybody.
Slide for the call for paper. This is the last.
Oh, sorry, everybody. If you're still here, they'll be starting up again in the spring, and please submit papers to be included in the series.
Yeah. Harry, you should submit your paper.
Yeah, will do. Yeah,
Yes,
thanks a lot. Yeah, good to see you.
Thank you. Yeah,
Thanks,
thank you, everyone.
So just one more.